welcome to Talking About Finance. As usual, 7 charts, 7 days. Let's see what's happening over the past week. Mr. Biden's spending plan passed last night. I woke up this morning to the news. We suspected it would. It's got to go back to the House and be reaffirmed, and they're hoping to get it signed, or Mr. Biden's hoping to sign it by March 14th, which was when a lot of benefits that are currently in place in the United States expire. I thought what we would do is we would take a look at the previous problem that we had in the global financial crisis and what they spent then. So you can see when you take a look at this back in 2009, US GDP was about 14.7 trillion. Stimulus was 787 billion. It was roughly 5.3% of GDP. And now it turns out that when we take a look at the spending or look at GDP, it's roughly 21 trillion, 20.934 billion, and stimulus is 1,900 billion or 1.9 trillion, and that represents 9.1% of GDP. Now, I know the plan has been criticized, and I haven't read through it in great detail, just at a summary level. A lot of people are saying there's pork in it. I don't know. They're getting $1,400 checks to adults, eligible adults, as well as the children. Unemployment and benefits, another $300 a week, extended through September 6th. Some $350 billion in bailouts for cities, states. $3,000 per year per kid between the ages of 6 to 17, and $3,600 for kids between the ages of 0, essentially, babies, all the way up to the age of 6. Some $170 billion for schools and $100 billion for public health. It was really actually cool. They're going to cap healthcare premiums at 8% of income and a few other niceties. So it's sort of hard for me to look critically at this. It does seem that it's definitely pretty good for the people. China is showing us the way to deal with this. Remember, America and the Western democracies are ramping up the debt. And we've talked about that over the past couple of weeks. I've shown you the balance sheets. Really amazing. The ECB now is the largest central bank on the planet. They've got roughly $8.6 trillion in assets. It's enormous. And they keep buying stuff. It's really wild. China, on the other hand, they do get criticized for debt. And again, I like to look at data. And that's a little unfair to criticize China for debt, because you can see the PBOC's balance sheet is trading at roughly 2004 levels. And what they're doing is they're letting defaults happen. It's not like what's going on in the West where they're just bailing out companies and entire industries. They're actually letting the defaults happen. And that's commendable. That's the way America used to work, with creative destruction. We would just let the defaults happen and move on from there. We're not doing ourselves any favor by running up all this debt. We're starting to see signs of stress in treasuries, and this is particularly interesting. Here I've got the bid-ask spread on the 30-year bond, the long bond. And what we're doing is we're taking the bid yield minus the offer yield. And you can see all the way up until a year ago, they traded in a tight band. And then something happened, the corona crash, of course. We saw this huge spike. And since then, the spreads have been relatively wide compared to, if you go back to 2016 up to 2019, or even, indeed up until February of 2020, they've been relatively tight. Now they've widened out, and this tells us there's stress in the treasury market, and that's something to keep an eye on. Wall Street, what we've got here is we've got, basically we're looking at the number of buy recommendations at Wall Street firms over the past week. And check this out, on the right-hand side, you can see it's relatively low. It's really down there, guys. So they're not recommending stocks, but again, my view of analysts is a little negative. I've worked in finance for many years, and sometimes, very often, I should say, they're biased by things that happen at the firm, so they really don't express what they want to say. But people don't really pay attention to them because their record isn't good. And this isn't my work, this is off FinTwit. But you can see here, guys, if you take the buy recommendations at Wall Street firms, and then underneath it, you've got the S&P 500. Read it from the left. You can see going all the way back here to 2016, January 2016, we reached a drop in buy recommendations, and the market was fine. The market progressed very nicely. And you can see it's the same pattern across all these drops. There's a couple outliers. There's a couple times that it didn't perform. Those are in red. But aside from that, their track record just isn't that good. It's really, really interesting. Now, people have money. And this is why it was really good for the Mr. Biden spending plan. They lowered the eligibility, so not everybody's getting it. Only individual single taxpayers that make less than 80,000 will be getting it. So people are sitting on a lot of money, and a lot of the articles I'm reading are saying there's going to be a huge boom. I wonder. People might be scared. We saw that after the global financial crisis. People were really scared, and the spending did not resume immediately. It took a number of years for spending to bounce back. We'll have to see if this happens. I'm dubious that people are going to go out there and piss through all those $2.9 trillion. There might be a little bit of increased spending, but I don't think we're going to see people flushing their savings accounts out. But the markets always talk to us, guys. And the markets are telling us something is going on. Check this out. I've got the stay-at-home trade. Of course, Peloton, Chewy, Roku, and Zoom stars of lockdown in the sense that their stocks soared. They did really well until February 8th, and they've been dropping down since. You can read the numbers. Peloton down 29%, Zoom at the other extreme, and Roku 19%, and Chewy right in the middle at 25%. The market is telling us the stay-at-home trade is over. It's done. All right, guys, thanks for your time. Take care.